Hi there, Serial Trader here. Let's have a look at the major US indices, and we'll start off with SPX here, looking at the Elliott wave charts. Alright, so the rally continues, to many people's surprise. So we had that potential pivot near the equality relationship and also the 618 retracement of this entire leg down. It did not hold. We've broken higher, and the next real potential level to pivot at is a couple places. So this previous resistance level right here, that comes in at 26.85.44, so not too far away from today's highs of 26.75, about 10 points away. And then we have the 786 retracement of this entire leg down, and that comes in at 27.03, so right around that 2700 mark. And then technically, if this is a 1 down, 2 up, 2 can retrace up to 100% of wave 1, although usually that 786 is kind of the retracement of last resort before you really start losing confidence. But technically, anything up to and including 100% retracement, so anything up to 2818 but no more, is potentially still a wave 2 retracement. I'll certainly start having doubts if we get beyond that 786 in any significant way. Now, if we do get above this area up here, so we have this kind of zone, 2818 is that one. Then we have the 2815.15. So if we get cleanly above all that, then we have to start looking at this chart differently, because that will actually start breaking the overall downtrend, and it'll definitely put some things into question and certainly elevate bullish potential to a much higher level than it currently seems to be at. Now, that being said, as long as we do find a lower high below this one right here at 2818, I still like the idea that we're at least coming down for a good retracement, if not a challenge or break of the lows. But at this point, on a short-term basis, it simply has to stop going up, find a top, and start rolling over before we could really get too excited about anything. As far as my positions, so I still have the existing February VIX call 16 strike, and also the 260 strike March SPY puts. I'm certainly not adding to them yet. At this point, I would not want to even consider adding to any of those positions until I see some signs of a reversal and actually start coming down. So we'll get to that in a bit. But let's go to this chart. So this is starting to lose a little credibility here. If this was just a nice WXY, we're getting beyond the point almost where that appears to be the right pattern. And you can see well beyond that equality relationship. And this is starting to look a little more impulsive, right? Although still technically it's acceptable as long as we stay above the origin of this wave down. I believe this is also the top of the monthly bearish engulfing candlestick from December, but we'll look at that on the candlestick chart as well. So that would also be an invalidation level of that bearish engulfing monthly. But again, we'll look at that once I go to the other platform. So one thing I'll point out is this interpretation, although initially not looking very promising, the bullish interpretation off the bottom, this is starting to gain a little traction here. Okay, we got potential 5 up for 1, 3 down for 2. And then we have a move up for 3. And yes, 3 isn't very long and it's shallower in slope. But as long as 5 ends up being shorter than 3, that's still acceptable to label this a 5-wave advance because, using the rules of Elliott, wave 3 is usually the longest, but the actual rule is it just can't be the shortest. So if wave 1 is longer than wave 3, wave 5 will need to be shorter than wave 3. And so far it is still shorter. So let's just take a little rough measurement here. So if that's the end of wave 3, projected off the bottom of wave 4. So that's how much farther up roughly we can go before wave 5 would start to be longer than wave 3. And that would be well above 2700, high 2720s. So a little wiggle room there as far as this being a viable wave count off the bottom. So if this is the case, and we do have a clean 1, 2, 3, 4, and it's starting to look okay. So we have 1 ABC zigzag down wave 2, 3. We have a triangle wave 4, so good alternation. We have a zigzag alternating with a triangle. So one's a sharper correction, one's more of a sideways correction. So that actually fits quite well with the guidelines. And then we're coming up in wave 5, looking pretty mature within wave 5. Now let's say today, I'm not saying it is, but let's just say today was the peak of wave 5 of possibly the initial wave 1 up. We'd still be looking for a nice corrective 3-wave decline in some sort of Fibonacci retracement here. So you'd still be looking for a sizable decline, and that would be either an opportunity to get out of some bad shorts that we're in here, or enter some longs on a nice corrective. Now the key is that this comes down in a nice corrective, non-threatening fashion, comes into a nice fib zone and then reverses. That'll be kind of the nice long setup should it happens. Now if we just come down and just keep going down and tank, that'll be more in line with my current favorite interpretation, that yes, we're just doing this strong bear market rally and then coming back down to make new lows. But this, just from a pattern standpoint, this is starting to gain some traction that we might actually have a good 5-wave ups developing off the bottom. But again, looking very mature the upside, even in this bullish scenario, looking very mature. Looks like a very poor place to enter, and you just have to wait for that pullback, even if you want to be bullish, right? And hey, you know what? Even though I have some bearish positions right now, if I see this and we come down in 3, come into that fib zone, set up a nice trade there, I'll switch bullish. Absolutely, I have no problem going bullish or bearish. It doesn't matter to me. All that matters is that I make money. So, we'll keep an eye out for this one. But one thing before I switch to the Thinkorswim candlestick chart, one thing before I part there. So bear market rallies have an incredible tendency to make the bears give up, make them think that they're wrong, and that it's not bearish anymore, and suck the bulls in. That fear of missing out mentality, suck them right in at the worst possible time and then pull the rug out. So what would do the most damage to the greatest number of people? Well, I'd say sharp decline from near current levels would do that. Bears have given up. A lot of bears have covered. They're too scared to go short now, or they're too wounded. A lot of bulls are already in, and there's some real late bulls still coming in, buying likely near the highs. So that would basically hurt everybody to come down here, and the market usually likes to hurt everybody it possibly can. That's certainly a tendency, at least from a trading perspective. I've noticed that. So as convincing as this is starting to look to the upside, still got to be skeptical until we get actual invalidation, and that would require, in my opinion, the unlikely break of 2800 plus up here. But we'll keep an eye on it. Certainly, even in this, most bullish of interpretations where we have the low in here in December, we're still looking mature, still looking like a potential mature 5 waves off the bottom, looking for that, decent retracement down. So either way, bullish or bearish, we're still looking for some weakness here pretty soon. Okay, now we'll go to the Thinkorswim candlestick chart. So we actually had a gap up today in the already overbought condition. That could be a warning sign. And obviously the first sign that we're coming down will be coming down to fill that gap. Again, at this point, excuse me. At this point, before I'd even consider adding to any bearish positions and anything like that, I need to see a compelling sell signal and a close below the daily T line. That would be the first sign that we're actually coming down in some sort of significant way. But, look at this. On Thursday, we had another bullish engulfing, and then today a gap up today. So, searching for a top, but we just haven't found one yet. Now, on the weekly candlestick chart, this is starting to look a little more menacing. We're well above the weekly T line, which we really weren't able to do any time during this major decline we've had. So this is somewhat notable. Again, I'm not convinced yet, but certainly I'm on notice. Certainly on notice that something more bullish could be developing here. And most importantly, in my opinion, let's look at the monthly. And this will coincide nicely with the invalidation of the wave count, I believe. So we have this bearish engulfing monthly candlestick from December. So the only way to negate this bearish engulfing monthly candlestick is to actually get above the high, and that is 2818, and that's the same level that invalidates the 1212 count on the Elliott wave interpretation. So that is the line in the sand before I'll turn, or not before I'll turn, but before I'll begin looking at this with a much more bullish tone. That would be the level to take out, 2800.18. Invalidating the monthly candle and also invalidating the current wave count. And you can see we haven't even quite come up to touch that monthly T-line, which we did do in November. And you can see weren't able to close above that in November, so that'll be something to look for here in January. And that's currently at, let's see what that's at currently, 26.99. So right around 2,700 is the monthly T-line. So that's a potential area to peek out at or find some resistance at. But again, it'll keep going up until it doesn't. Certainly looking ripe for a reversal here, but until we get one, it can just keep going and pulling more people in while it does that. All right, so that's good for SPX. We are cleanly above the 50-day simple moving average now, so that's somewhat notable. Maybe we'll go up and touch that 200, as that provided, kind of a point of interest before. Broke below it, retested, broke below it, retested, then broke big. Maybe we retest it again. Who knows, but something to look for. And we also have the top of this base channel, and that would be right around 2710, 2715 currently, just above 2700. Okay, so that's SPX. Look at the Dow Jones Industrial Average. They're all looking very, very much the same here. The Dow above its 50 as well. We don't have the gap up on the Dow, or we certainly closed the gap intraday anyways. Let me just confirm that and get in real close here. Yes, so no gap on the Dow. Still a gap on SPX, though. Dow's getting up closer to its 200-day moving average, which is currently at 24,969. Invalidation level for the Dow. That comes into play here at 25,980. Still a decent ways away. Roughly 1,000 points away on the Dow. Kind of doubt we get there, but something to look for. Also, the top of this base channel here on the Dow, that comes in at right around 25,225 or so. Now on the weekly chart for the Dow, we're not quite up to that 50-week simple moving average. Obviously, we're well above the weekly T-line here, and the weekly 3 T-line is starting to cross above the T-line. So we're certainly on notice that something could be changing here, but again, has not invalidated the bearish outlook just yet. We'll look at the monthly and see where the Dow would invalidate that monthly candle from December. So the monthly bearish engulfing from December would be invalidated on the Dow if we get above 25,980. So that's the line in the sand to start changing our tone here. Now we're right up at near that monthly T line. That's currently at 24,781. We went as high today as 24,750. So we're very close to it, within 30 points or so. So it might be an interesting place to find resistance and potentially reverse from. But again, we're not done the month yet. We're only about halfway through, or a little more than halfway through. Okay, that's good for the Dow. Go to the Nasdaq Composite. And on the Nasdaq Composite, interesting. So on the channel here, we're right up at the top of this channel now on the Nasdaq. Another potential doji reversal here. Larger upper shadow and lower shadow, smaller real body. But again, a doji just not enough at this point. We need to see some actual confirmation and a close below the T line, and we're just not doing that yet. We're now well up above that 50-day simple moving average. No gap up to fill here on the Nasdaq Composite, so it's only SPX that has the gap up. The 200-day simple comes in at 74.51.43 on the Nasdaq. And also the invalidation of the 1212 count would come in here at the top of this candle. And that's at 74.86.51. So some key levels to be aware of. The weekly on the Nasdaq. Okay, we're up well above the weekly T line here. 3 T lines crossing above the T line. So that's again somewhat bullish development, but we'll see if this can actually change things here. And I'm being very demanding of this to change my mind. So on the Nasdaq Composite, this is the bearish engulfing monthly from the December candle. That comes in at 74.86.51. So we break that, and then at that point, again, start looking at this with a much more bullish tone. But obviously, we'd still be wanting to only go long on a nice, corrective 3-wave pullback, which obviously we haven't had yet. So that's the Nasdaq Composite. And we'll look at the VIX. So on the VIX, we did a little doji today in the VIX. We did go a little lower. Still haven't broken below kind of that key 16 level that we found support at before. We also haven't quite touched that 200-day moving average where we also found support before. Obviously, VIX in the oversold condition as the equities are in their overbought condition. And VIX has to start, breaking this shorter-term downtrend, start making some higher highs and higher lows to assert that, we've got a top in equities and a bottom in VIX. But no evidence of that yet. A little hint, maybe. Today is a doji. But we'll see. So VIX yet to show its hand. Certainly looking like an attractive place to go long on the VIX, but no confirmation yet. Now we'll look at, just before ending here, we'll look at the VIX VVIX tool. And currently, not really seeing any clear divergence here. VVIX starting to move up a little more strongly than VIX, but nothing substantial. And VVIX starting to get above its red moving average, although SPX well away from getting below its blue moving average, which would be a confirmed signal. And that currently comes in at 26.19, so right around 26.20 would be the moving average for that SPX sell signal to start confirming. But again, we're still on technically we're still on the buy signal here. We've had this buy signal since way back here on the December 28th. We got that buy signal here. After having our VIX VVIX divergence, VVIX got below that red moving average. SPX got above the blue, and we've been on that buy signal technically. We've not been able to go on a sell signal since then. So that's produced an incredible rally, certainly much larger than I would have originally anticipated. But still waiting for a new signal to develop here, and it's just not there yet. All right, that's good for now. Serial Trader signing off.